Hello, this is Japanese Economic Review Channel. This time, let's take a look at SBI Securities' domestic weekly outlook. The Nikkei is hitting these historic 60,000 point highs, which sounds amazing, right?
Oh, absolutely. On paper, it looks incredible.
But, beneath the surface, the majority of stocks are actually quietly tanking.
Yeah, they really are.
So today, we're doing a deep dive into why this massive AI boom is simultaneously breaking all these records and, well, kind of suffocating the broader market. Welcome to our deep dive into the forces that are basically tearing the markets in two completely different directions right now.
Right, and it's quite the tug of war.
It really is. So we're looking at three core themes from the latest SBI Securities outlook. First, we'll cover the massive contradictions in this week's stock market. Second, we're going to look at the materials of interest and exchange rates, specifically this geopolitical tug of war that is actively dictating the value of the yen.
Which is incredibly volatile right now.
Oh, totally. And finally, we're going to walk you through a highly detailed breakdown of the weekly timetable so you know exactly how to interpret the absolute avalanche of data hitting the tape this week.
I mean, it is genuinely a fascinating week to analyze because, well, the standard economic models are kind of colliding directly with raw geopolitical tension. We are seeing major structural shifts just play out in real time.
So let's start with that glaring contradiction in the stock market. I mean, we have to look at the big, flashy headline first, the Nikkei average testing that 60,000 mark.
Right, historically, it is a staggering number.
It is, and we know it's being driven almost entirely by, just a handful of massive AI-related stocks. But as I was reading through the underlying data in the SBI outlook, this image just kept popping into my head.
Oh, yeah? What kind of image?
Well, the market right now, it's kind of like a swan gliding across the lake.
A swan. Okay, I like that.
Right,
Yeah.
because from above the water, you're looking at that 60,000 number, and it looks beautiful, it's graceful, it looks effortless. But underneath the water...
It's paddling furiously.
Exactly. It's paddling furiously and just struggling to keep moving forward.
That swan analogy is, it actually captures the internal divergence perfectly. What we're seeing is just a sheer disconnect between the top-line index number and the actual, fundamental health of the broader Japanese market.
Yeah, because the numbers in the report, they paint a pretty grim picture of that underbelly. Market psychology is remarkably poor. I mean, when you look at the prime market, the number of declining stocks is just consistently outnumbering the advancing ones.
Right, and it's not even close.
No, not at all. We're actually seeing many individual companies hitting year-to-date lows on the exact same days that the index itself is celebrating all-time highs.
What's fascinating here is the mechanics of why that's happening. The market is currently trapped between two incredibly powerful, totally opposing forces.
Okay, break that down for us.
Sure. So on one side, you have the gravitational pull of the AI boom. We are talking about massive, almost unprecedented revenue expectations for AI infrastructure.
Like data centers and stuff.
Exactly. Semiconductors, data centers, the whole ecosystem that supports machine learning. The market is pricing in literal decades of growth for these companies. And because they are weighted so heavily, they just pull the top-heavy index up.
Right. But then there's the other side of the ledger.
Right. On the other side, we have the worsening situation in the Middle East.
And, that geopolitical tension isn't just some abstract headline you read on the news. It has a direct mathematical impact on traditional industries because it drives up raw material costs.
Specifically energy costs.
Yes, energy. It acts like this suffocating blanket on any company that actually manufactures physical goods.
That is the core friction point right there. But the situation is actually even more complex for manufacturers. Cost-push inflation is the dominant theme here, and it's coming from two directions at the exact same time.
Oh, wow. How so?
Well, you have the geopolitical instability making the raw energy required to run a factory more expensive. But simultaneously, the AI boom itself is inflating the cost of semiconductors across the board. Oh, because the tech giants are willing to pay just an absolute premium for advanced chips, right?
Exactly.
Which creates a massive supply crunch for literally everyone else.
Precisely. So if you are an ordinary manufacturer, say you're building cars or home appliances or, I don't know, medical devices, you rely on those chips too.
You absolutely do. Everything has a chip in it now.
Right. But you are now getting squeezed by both high commodity costs coming from the Middle East and high component costs coming from Silicon Valley.
Right.
So the AI giants are raking in cash, but the traditional economy is experiencing a severe margin squeeze. It's a dual economy scenario.
Playing out right in front of us. And, knowing that the broader market is feeling that squeeze and knowing that the AI space has this strong sense of, well, overheating where we might actually see some aggressive profit taking, it makes sense that investors are looking for an alternative play.
They absolutely are.
And reading through the SBI analysis, the pivot toward heavy industry really stands out as the most logical safe haven. It is a very rational pivot. I mean, when you step back and look at the global landscape right now, there's a massive investment appetite in three very specific, highly physical areas:
Which are?
defense, aerospace, and energy infrastructure.
Which is the ultimate irony, if you think about it. The very geopolitical anxiety that's crushing the broader market is the exact catalyst driving the heavy industry sector.
Yeah, it's a complete paradox.
Right. Countries are looking at the global map and deciding, hey, we need to rearm, we need to secure our airspace, and we desperately need to build and upgrade our own domestic energy grids so we aren't so reliant on these volatile global supply chains.
And the market is pricing in that exact reality. The outlook specifically points to strong recent earnings from GE Vernova and Boeing over in the U.S.
Oh, right.
And domestically, Mitsubishi Heavy Industries is positioned as a core beneficiary here. The report notes that market sentiment around Mitsubishi Heavy seems to have fundamentally shifted just this week.
Wow, just this week.
Yeah. Investors are finally realizing that building physical resilience is going to be the dominant theme of the next decade.
So considering that shift, the outlook actually provides an expected range for the Nikkei of 56,500 to 60,500, which to me implies a high probability of a pullback.
It does.
Basically a reality check on those overheated AI stocks as the money rotates into sectors like heavy industry.
Yeah, that range absolutely bakes in the expectation of profit taking. Look, when a specific asset class like AI infrastructure gets this structurally hot, a cool-down period isn't just likely, it's a mechanical necessity for the market to actually digest those gains.
But the report also outlines this massive geopolitical wildcard.
Oh, the Middle East scenario.
Right. If the U.S. and Iran were to suddenly reach a diplomatic peace deal, if they negotiate an agreement and the Strait of Hormuz is immediately reopened and secured, that expected range just goes completely out the window.
Yeah.
Right.
Completely out the window. A sudden de-escalation in the Middle East would instantly erase the geopolitical risk premium on raw materials.
Because oil prices would drop.
Exactly. The immediate drop in oil and energy prices would relieve that margin squeeze on the traditional manufacturers we were just talking about. In that specific scenario, the market would likely shed all its anxieties overnight, and we would see a massive, broad-based rally.
A rally that lifts the entire prime market, not just a handful of tech giants.
Exactly.
So if a Middle East peace deal is the wild card that could flip the stock market overnight, the current lack of a deal is actively tearing the currency market apart. So let's move to our second topic. How is this geopolitical tug-of-war actively shaping the yen right now?
The mechanics of this currency struggle are just fascinating. We saw it play out vividly just last week, actually.
Walk us through it.
Well, when Iran's actions essentially closed off the Strait of Hormuz, that created an immediate, tangible threat to the global oil supply. And because global oil is priced and traded in U.S. dollars, rising oil prices mechanically increase the demand for dollars.
Oh, I see.
So geopolitics alone favored a stronger U.S. dollar and a weaker yen.
But the dollar didn't just have geopolitical fear pushing it up, right?
Right.
It had hard domestic data, too, because we saw stronger than expected U.S. retail sales numbers hit the tape at the exact same time.
Right.
And strong retail sales mean the American consumer is still spending heavily, which in turn means U.S. inflation is going to remain sticky and really difficult to bring down.
You're hitting on the core macro dilemma right there. Sticky inflation fundamentally pushes back the market's expectations for when the Federal Reserve can safely cut interest rates.
Because capital flows toward higher yield.
Exactly. So the longer U.S. interest rates stay high, the more attractive the dollar becomes compared to the yen.
The tricky part, though, is that the geopolitical side of that equation has been incredibly volatile. I mean, the report notes that former President Trump extended a ceasefire deadline, which initially looked like a huge de-escalation.
It did look that way for a minute.
But then, almost immediately, talks stalled out because Iran's parliament speaker just stepped away from the negotiation table. It's like the market is trying to price in peace 1 hour, and conflict the very next.
And that whipsaw effect leaves the central banks in an incredibly difficult position. We are looking at an impending gridlock. I mean, the Bank of Japan, the Federal Reserve, the European Central Bank, the Bank of England, they all have major meetings or data releases coming up, but nobody wants to make a definitive move.
It's like a massive staring contest.
That's exactly what it is.
Because on the Japanese side, the initial expectations that the Bank of Japan would execute another rate hike are just completely receding. They're looking at the fragile domestic market psychology, the struggling manufacturers we just discussed, and they're realizing they can't risk tightening the screws right now.
And across the Pacific, the Federal Reserve is looking at that robust retail data and realizing they can't risk a rate cut without reigniting inflation. So both central banks are essentially frozen in place.
Which leaves the dollar-yen exchange rate trapped in this expected range outlined in the report. 157 yen on the low end to 162 on the high end.
Right.
The 157 mark acts as the technical floor, hovering right near the 26-week moving average. But that 162 ceiling isn't just a technical resistance level from July of 2024. It is an artificial, purely psychological barrier created by the Japanese government.
Yes. The threat of direct currency intervention. The report explicitly warns that as the exchange rate approaches that 160 yen mark, the Japanese Ministry of Finance and the BOJ are highly likely to step in.
And the mechanics of that intervention are brutal for currency speculators. Because if the BOJ intervenes, they dump massive reserves of U.S. dollars into the open market and just aggressively buy yen.
Right, artificially forcing the yen's value up.
Exactly.
And currency traders are fully aware that the authorities are drawing a line in the sand at 160. So even though the massive interest rate differential between the U.S. and Japan screams that the dollar should go higher,
They're so scared.
exactly. The fear of being caught on the wrong side of a sudden, multi-billion-dollar BOJ intervention keeps buyers incredibly cautious. It creates this heavy artificial lid on the dollar's upward momentum.
So if the Bank of Japan is terrified of stepping over that 160 yen line, their upcoming policy meeting isn't just routine, it's a tightrope walk.
A very dangerous one.
And that kicks off a completely brutal, highly consequential calendar this week. Let's move to our third section and unpack this. Let's break down exactly when and how these macroeconomic theories are going to be tested in the real world with the weekly timetable.
The timetable this week is essentially a gauntlet. I mean, every single thesis we've discussed regarding AI, heavy industry, and currency intervention is going to face hard data.
Okay, so we start on Monday, April 27th. The Bank of Japan's two-day monetary policy meeting officially begins. Over in the U.S., there are note auctions and Verizon earnings. But domestically, we get a slew of tech and pharma earnings, specifically Hitachi, Astellas Pharma, and, crucial for our earlier discussion, Advantest.
Ah, Advantest. They are the canary in the coal mine for the entire semiconductor narrative.
Because they build the automated testing equipment that the foundries actually use to verify the chips.
That's right. Because before a next-generation AI chip can be sold, it has to be rigorously tested. If the founders are anticipating massive future orders, they buy more Advantest equipment today.
So traders are going to be scrutinizing Advantest's forward guidance.
Absolutely. If their order books are slowing down, it is the first hard evidence that the overheating AI phase is actually cooling, which would immediately ripple through the entire Nikkei.
Wow. Okay, that sets up Tuesday, April 28th, which is arguably the most crowded day of the week. We have domestic unemployment data. We have the U.S. Federal Open Market Committee, the FOMC, starting their meeting, along with U.S. consumer confidence data. Massive global earnings drop from Visa, GM, and Starbucks.
So much data.
Right. But what would you say is the absolute anchor of Tuesday? It's got to be Bank of Japan Governor Ueda's press conference, right? Alongside the release of the BOJ Outlook report.
Yes, Governor Ueda's press conference is going to dictate the currency markets. As we noted, the market already expects him to hold rates steady. What institutional traders are desperate for is his tone.
They are parsing every single adjective he uses.
Literally, they want to know how the BOJ views that 160 yen intervention line. Because if Ueda sounds even slightly dovish, like if he suggests that the BOJ is comfortable leaving policy ultra loose for an extended period,
Speculators will pounce.
exactly. Currency speculators will immediately test that 160 threshold to see if the Ministry of Finance actually has the stomach to intervene. And on the equity side, that same day, we also see Shin-Etsu Chemical and Mitsubishi Electric reporting.
Which are perfect barometers for the dual economy we discussed earlier.
Yeah.
I mean, Shin-Etsu manufactures the foundational silicon wafers used in both high-end AI servers and standard automotive components, making their earnings a perfect cross-section of global manufacturing health.
Absolutely.
Moving to Wednesday, April 29th, we hit what I call the holiday paradox. It is Showa Day in Japan, a national holiday, so domestic markets are closed. But the rest of the world is running at full speed.
Oh, this is a tricky day.
Very. The European Central Bank meeting begins. Fed Chair Powell gives his highly anticipated press conference, and it is the biggest day for big tech earnings. Alphabet, Meta, and Microsoft all report.
This is a highly vulnerable, dangerous day for Japanese assets, specifically because of the market mechanics.
Yeah, it's a liquidity issue. For you listening, think of the currency market like a massive swimming pool. On a normal Tuesday, the pool is completely full of water, meaning millions of active buyers and sellers. If a massive institution makes a huge trade, it's like a cannonball.
Right.
It makes a splash, but the deep water easily absorbs the shock. But on a Japanese national holiday, half the water is just drained out of the pool.
And into that shallow pool, you have Fed Chair Powell potentially confirming that U.S. rate cuts are delayed indefinitely.
Which is a massive cannonball.
Exactly. Without the massive volume of Tokyo trading desks open to absorb that shock, the price swings in the yen could be violently exaggerated. Furthermore, having Alphabet, Meta, and Microsoft reporting their cloud and AI infrastructure spending on a day when Japanese semiconductor stocks literally can't trade to react to the news.
It creates massive pent-up volatility for when the market finally reopens.
It really does.
Which brings us to Thursday, April 30th. This, frankly, looks like the mother of all global data dumps.
It's intense.
In Japan, we get industrial production and commercial sales data. The Eurozone drops Q1 GDP and unemployment numbers. The Bank of England has their meeting, and CB President Lagarde gives a press conference. But the two most critical pieces of data are the PMIs out of China and the PCE deflator out of the U.S.
And those metrics are the absolute bedrock of global macroeconomic forecasting right now.
Let's break down exactly how they work, starting with China's manufacturing and non-manufacturing PMIs, or Purchasing Managers Index, because this isn't just a backward-looking report on what was sold, it's a forward-looking survey of the people actually buying the raw materials.
Right.
If purchasing managers at Chinese factories are suddenly buying up massive amounts of cardboard boxes and copper wire, it means they have hard orders in their system and expect future sales to expand.
And a reading above 50 indicates industrial expansion. So comparing that Chinese factory floor optimism against Japan's industrial production data gives traders this crystal clear picture of the Asian manufacturing engine, totally independent of the Silicon Valley AI hype.
And speaking of independent data, we get the U.S. Q1 GDP and the PCE deflator. Now, I know the Federal Reserve obsesses over the PCE, preferring it even over the Standard Consumer Price Index.
They do, yes.
The reason is that the PCE deflator tracks actual consumer substitution. So if beef gets too expensive due to inflation, the CPI just notes the high price of beef. But the PCE deflator recognizes that consumers will actually switch to buying chicken instead, giving a much more accurate reflection of actual ground-level inflation.
And that single data point will either vindicate or completely destroy whatever Fed Chair Powell claimed during his press conference the day before.
Wow.
If the PCE shows that inflation is reaccelerating, the hope for a 2024 rate cut vanishes. Thursday also brings earnings from Apple, Samsung, and Tokyo Electron. And watching Tokyo Electron report its semiconductor manufacturing equipment sales right alongside the consumer demand figures from Apple and Samsung gives us a complete 360-degree view of the electronics supply chain.
Which perfectly sets the stage for the finale on Friday, May 1st. We get the Tokyo Consumer Price Index data right out of the gate, and the U.S. ISM Manufacturing Index to wrap up the week. While major European and Asian markets are closed, what really stands out on Friday is the absolute dominance of the Japanese trading companies reporting earnings.
Ah, the Sogo Shosha.
Yes, we have them all lining up. Mitsubishi Corporation, Mitsui & Co., Itochu, Marubeni, and Sumitomo Corporation.
The trading houses are the ultimate proxies for the physical global economy.
Because they don't just invest in companies, they actively manage the physical logistics of the entire world. They touch the shipping routes for the coal, the mining operations for the copper, the global food supply chains, and the retail distribution networks.
Which basically brings us full circle to the very first topic we discussed today.
It does.
The raw material inflation caused by the Middle East, the urgent pivot toward heavy industry, the need for secure energy infrastructure. These trading companies are literally the entities managing those physical supply chains. They are the shock absorbers for global geopolitical risk.
Exactly. Their earnings will show us their current margins, but their forward guidance is basically a masterclass in geopolitical risk assessment. They will tell us exactly how much that Middle East instability is costing the global supply chain and whether the consumer or the manufacturer is ultimately paying for it.
It is a week that demands absolute attention. I mean, from the AI-driven heights of the Nikkei down to the heavy industry shift, the geopolitical threats pushing the yen to the brink of government intervention, and this incredibly dense calendar of earnings and central bank decisions.
It is a massive amount of data to process, but understanding the mechanics behind these numbers,
Right.
how a tight currency pool reacts to an interest rate shock, or how a single semiconductor testing company dictates the sentiment of the entire AI market is how you actually cut through the noise.
Absolutely. And as you look ahead to this week's trading, I want to leave you with a final thought to mull over. We've spent a lot of time today talking about the virtual AI boom and real-world geopolitical risks as two separate, often opposing forces.
Right. One is pulling the market up while the physical constraints drag it down.
Exactly. But consider the long-term mechanics. AI requires almost unimaginable amounts of electricity and physical infrastructure to power and cool those data centers.
Oh, that's true.
So, will the massive, insatiable energy demands of the AI boom eventually force unprecedented capital investments into the very heavy industry and energy grid sectors we talked about? Could it be that the virtual AI bubble actually becomes the financial engine that funds our real-world geopolitical resilience and energy independence?
Wow. That is a brilliant framework to keep in mind the idea that the virtual world's hypergrowth might ultimately be forced to rebuild the physical world's infrastructure. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.